Good day, everyone. Hope you all are doing well and staying safe. I am Rachna Makija, Senior Research Analyst with iFAST Financial India Private Limited, and I am here for yet another informative fun interaction today. We all like investing in stock markets, but again, it is subject to stock specific risk. Exchange traded funds or ETFs are mutual funds that invest into the basket of securities tracking a specific index, sector, or strategy. These funds are can be bought directly into the stock markets, unlike those traditional funds. Being a passive product mostly, ETFs can also offer advantages like lower cost than active funds and liquidity on exchanges. Some ETFs also directly invest into international markets nowadays. These offers Indian investors a chance to globally diversify their portfolios. To help us understand a little more about how an international ETFs works and their benefits, I have here with me Mr. Siddharth Srivastava, Head of Product and ETFs from Mirae Asset Management Company. Siddharth has more than 10 years of experience in financial services and stock markets and currently leads the passive investment products with Mirae. Welcome, Siddharth, to the session. Now, Mirae Asset is launching with the international fund offer, the Mirae Asset FANG plus ETF and fund of fund. So, Siddharth, can you please shed some light on your new NFO and also highlight us the differentiating factors of the NYSE FANG plus index and fund and ETF?
Sure, Ashna, I'll do that. So I'll quickly share my screen.
Yes, sure, Siddharth.
Yeah, so we are coming out with another very interesting product, a very innovative offering, which will provide exposure to the NYSE FANG Plus index. And in fact, we are coming out with two offerings, two investment vehicles, which investors can use to take exposure in this index. One is an ETF, which will be known as Mirae Asset NYSE FANG Plus ETF. And
Okay.
second one is the fund of fund, which is Mirae Asset NYSE FANG plus ETF fund of fund. So we'll have both the vehicles. It is up to the investor to choose the right vehicle as per his or her requirement. And the NFO is starting from 19th of April, and it is ending for the ETF on 30th of April and for the fund of fund on 3rd of May. So before I talk about why we are out with this offering and what different are we doing here, let's first understand why Indian investors needs to evaluate or consider doing global investing, right? Because last year US market gave phenomenal return, and I think now there are a lot of conversations which are happening about investing globally. So one very straightforward reason is that different geographies perform well in different point in time. If we look at last 10 calendar years, there were 6 calendar years in which US actually outperformed Indian markets. There are years when Europe has done well, there are years when the world index has done well compared to Indian markets, and obviously there are years when Indian market has done well. So if an investor wants to create wealth by investing in equity markets, he should not only look at Indian equity markets, but he should also explore investing in other markets, because these are also very good wealth creation opportunities. In fact, in last 10 years, US market have has done well, better than the Indian market. So just imagine if you would have invested in US market, you might have created more wealth through your investment. Second point being that currency depreciation also adds to the investor returns. Since 2009, INR depreciation should have typically added around 2.3% on an annual basis to the investor return. So that is also one reason, or rather one more avenue of creating that additional wealth, because on a long-term basis, typically INR, which is in a higher inflation regime, will depreciate against USD, which is in a lower inflation regime. Third very interesting point is, and that you will understand more when we are talking about the FANG Plus index, is that Indian equity market is just 3% of the global equity market. Just 3%. We are dominated by traditional sectors like oil and gas, bank, IT consultancy, etc. Whereas almost everyone know that there are a lot of interesting thing happening, especially on the technology front, which is changing the world we live in, which is changing the way we live in, and which is changing the society, right? We talk about a lot of mega trends which is happening, like e-commerce, social media, electric vehicles, cloud computing, and a lot of companies doing very well, these sectors doing very well because it is just changing the way things are happening. Sadly, these companies are not listed in Indian equity market. So anyone who wants to take such thematic exposure in different avenues and different themes, I think global market is the only way to take exposure in those particular themes. So if someone wants to invest in, let's say, e-commerce or social media, he needs to obviously go out and invest in foreign companies or a foreign fund which provides that exposure. And lastly, we discussed about returns. We also should consider the kind of correlation which India has with other global equity markets. For example, Indian equity market correlation with global equity market is round about zero point 0.3, which is though positive, but it is very low. So what will happen is if you're investing in multiple markets, your overall risk of the portfolio should ideally reduce because of the lower correlation. So not only you are getting more wealth creation opportunities, mediums, but you are also reducing the overall volatility or risk profile of your portfolio, apart from the fact that currency depreciation adds into the return. So that is why I feel that investors should obviously explore investing in global equity markets, and that can be a very good medium to add wealth or create wealth. Passive funds provide a very low cost tool to take this exposure. For example, the ETF which we are coming out with, the TER is around 33 basis point, 0.33%, which is very low compared to, let's say, active funds, which is around TER of 2.4%, or fund of fund, which is TER of around 1.9%. So passive funds provide a very transparent, methodology based, rule based exposure to a given portfolio at a very low cost. And that is why it should be one of the preferred vehicle to take exposure in the global markets. Now, I'll just quickly talk about FANG plus EDM. I thought that talking about why global investing makes sense in the start. So FANG plus, from an idea point of view, it's very simple. It provides equal weighted, concentrated exposure to 10 mega tech companies, companies which are high growth tech, internet, or media companies in the world. And the portfolio currently consists of, as the name suggests, Facebook, Apple, Amazon, Netflix, Google, Tesla, Nvidia, Baidu, and Alibaba, and Twitter. And as as I'm taking those names, you can very well correlate with all these companies, because these companies have become so much part of our life. The reason behind that is these companies have disrupted the way we are living, right? They have been the original innovators of several mega trends, including internet search, e-commerce, social media, etc. These companies are innovating right now. Let's think about autonomous vehicle and and electric vehicles. And these companies are working on some very innovative things right now. Also, they are simply not just sitting on the laurels, but they are investing a lot even in future. For example, these companies in an aggregate have acquired around 1,000 companies in their lifetime, with a total amount of almost $176 billion. Imagine the MCAP of Reliance is just $181 billion. So these companies in total have acquired a Reliance. In terms of R&D, they have invested around $68 billion in 2018 only, which is round about the size of Indian Oil. So we are talking about companies which are leading some very interesting mega trends, companies which have been the innovator in the past, and companies which are investing phenomenally to continue being the leaders in their respective domain and explore more domains for future innovative services and products. So, a portfolio which is focused on these companies, which will provide exposure to these 10 stocks in an equal weighted manner so that investor can participate in the wealth creation journey of these companies.
Okay.
And just to put one or two more points, while we say that these are just 10 stocks, these are not just 10 stocks in terms of market cap. The combined market cap is $7.7 trillion, which is almost 2.5 times the size of India's GDP. The total revenue of these companies is $1.09 trillion, which is three times the uh, size of Indian government total receipt. Cash balance is more than $50 billion, which is 85% the size of reserves held by RBI. So we are not talking about some small companies. We are talking about leaders which are big and which we expect to grow in future also, and hence provide a very good opportunity for investors to take exposure in these known names.
Okay. Thank you so much, Siddharth. Thank you for going into detail. What is the difference between FANG Plus Index versus the NASDAQ 100 Index then?
Sure. So Nasdaq 100 index provides a broader exposure
Okay.
to 100 large cap companies which are not part of a BFSI sector. So typically, it not only track tech companies, but it also track companies like, let's say, Pepsi is part of that index, Costco is part of that index, even Starbucks is part of that index. So it is a more broader index. You can compare it with, let's say, Nifty 100 minus the BFSI sector. Whereas the FANG Plus index provides a more focused exposure and equal weighted exposure to these 10 companies which are leaders in their respective domain. And the reason why these 10 companies are chosen is because these companies are deriving revenues from the emerging mega trends or disruptive technologies which I mentioned, like e-commerce, social media, cloud computing, etc. So this one is a bit different offering from the Nasdaq 100, which provides exposure to known names and equal weighted exposure to the known tech companies, which are high growth tech companies.
Okay, okay. Siddharth, we have seen a sharp re-rating in the FANG stock since the onset of COVID-19 pandemic. This, coupled with sector rotation in favor of value in the US, will restrict the upside in this space. So, why, in your view, does this FANG holds merit now at this hour with elevated Ps, in fact?
So let me first talk about the performance on what these companies have done historically. And on this slide, you can see that in last 5 years, FANG Plus has given a performance of 46.8% compared to 21.8% of NASDAQ 100, 17.3% of Nifty 50. If you're looking at a 1 year performance, we know that big techs have done very well. It has given a performance of 105% compared to 55% of NASDAQ 100 and 31% of Nifty 50. While the volatility is on the higher side, obviously it is there for usually for concentrated portfolio. But if you look at return to risk ratio, you'll find that in terms of return to risk, also FANG Plus is doing better than the Nasdaq 100 or the Nifty 50. And same story goes if you're looking at a calendar year return. It's not just about last year when FANG Plus has done really well. Even let's say in 2017, it has given 49% return compared to 30% of Nifty 50 and 25% of Nasdaq 100. But one very important point is that all this is backed by robust sales growth, which we have seen for FANG Plus companies. In last 10 years, the price on an average for all these 10 stocks have grown by 27.4%, whereas the earning itself, sales itself, have grown by 27%. So the earnings have been backed by, or rather, the price growth has been backed by the kind of earnings growth and sales growth which we are observing for the set of FANG Plus companies. So I think people should consider investment in FANG Plus portfolio or big tech from a long term point of view, especially if you are talking about global equity market or investing in global funds. You should ideally have an horizon of 3 to 5 years, right? And when you are thinking from that term, FANG Plus stocks earning projections is around almost 118% for next 3 years on an absolute terms, whereas for Nasdaq it's just around 70%. So just not only from historical perspective, these companies have grown both in terms of creating wealth for the investor, but also from earnings and revenue point of view. But based on earning projections, also these have done seems to be on the right track from for creating wealth for the investor from a long term point of view also.
Okay, okay. So, Siddharth, from an operational standpoint, we would like to understand a few things. Investment received before 3 p.m., that is Indian Standard Time, will be converted into USD and invested into the FANG Plus Fund of Fund and ETF in the same evening?
So I'll stop the screen share and we can go
Sure.
back. Right. But yeah, so there are two ways to buy and sell ETF. I guess everyone in the audience
Yes.
know about it. One is obviously you can go on the exchange and you can buy 1 unit, 2 unit, 100 units on the exchange itself, just like stocks.
Right.
Uh, and the second way which you are mentioning is coming directly to the AMC.
Hmm. Hmm.
Here will come in the multiple of basket size. So
Right.
basket size is 2 lakh units, which will roughly translate to, let's say, around 1 CR and change depending on the NAV of the ETF. But yes, if you're investing in a basket size directly with the MC and you come before 3 o'clock, what will happen is that we will take that money with the application amount, convert that into USD because obviously the investment is happening in the underlying stocks in USD. And when the US market opens on that evening, we'll
Hmm.
wait around, let's say, 30 to 45 minutes and then buy the underlying stocks to create that basket or to create that ETF units. So the NAV which is realized by the investor will be based on the deployment which is happening in the US market after the US market opens in the evening. And
Okay.
obviously the currency conversion will happen before that, where the entire quantum which is given by the investor will be converted to US dollars.
Okay. So before 3 p.m., we will be converting into the USD, right?
No, not before 3 p.m. It will happen after 3 p.m. Let's say around
Okay.
4 o'clock.
Okay, okay, sure. So, okay, so in case of fund of fund, will some percentages be allocated to the derivative segment?
No, fund of fund will only be investing in the underlying units of ETF. There'll be no derivative exposure. So, just for everyone's clarification, ETF will be investing in the underlying stocks,
Hmm.
no derivatives, and fund of fund will be only investing in the ETF and no derivatives.
Okay, sure. So, how will be the tracking error be minimized or managed, and any cash levels to be maintained in the fund of fund or the ETF?
Yeah, so that's a interesting question. So tracking error typically for a global ETF, let's say, is comparatively on the higher side. Right? While it is the objective of the AMC to reduce the tracking error as much as possible, but it won't be, let's say, comparable to what Nifty 50 ETFs have
Okay, okay,
because of currency conversion, because of the fact that you are dealing with a different time zone, because of the other operational nuances and other operational costs. It will typically be higher than Nifty 50, but obviously it will be our aim to have as low tracking error as possible for the ETF. And for the same reason, the cash in ETF will be negligible. It will be very less. Even for the fund of fund, what we'll do is we'll buy, let's say, if there's a larger quantum present, we'll buy it directly with the AMC, create fresh ETF units by deploying it in the US market, deploying the cash in the US market, or we'll buy it from the exchange itself. So in even in case of fund, we'll try to have as less cash as possible, let's say much less than 1% approximately, but with an aim that both the fund of fund and the ETF should roundabout generate the returns which the underlying NYSE FANG Plus index is generating, and having any extra cash just creates a cash drag and it introduce the tracking difference and tracking error, and we don't want that even in case of fund of fund.
Okay, sure. Okay, for the fund of fund, what will be the total expense ratio for the direct and the regular plans?
So I'll talk about ETF first. ETF
Sure.
PER will be around 33 basis point, which will be the lowest uh, priced fund in India to provide a foreign exposure. The fund of fund TER for a direct plan will be around 50 basis point, which will including the cost of underlying ETF. So it's
Okay.
3 plus 17. For the regular plan, it will be around 1%, again, including the cost of underlying ETF. So again, 67 plus 33 basis point of the underlying ETF cost.
Okay. Okay. Sure. So, is there any market maker facility available in case of ETFs?
So Mirae Asset AMC actually gives a lot of importance to market making aspect. In fact, all our ETFs trade with the lowest spread in the market from an AP point of view. I think we don't charge any additional spread when we are creating or other RAPs creating liquidity on the exchange. So we play obviously focus a lot on the AP's role, because obviously when people are investing on the exchange, they should invest at the right price with as low spread as possible. So even in case of the FANG Plus ETF, it will trade on the exchange. We'll have a market maker obviously providing both buy and sell quote at all times, and providing it with some as low a spread as possible. For everyone's information, we have our own sister concern, which is Mirae Asset Capital Markets, which is an institutional broker who does the market making for us. So we have a very tight control or QC maintained in order to just be sure that the right quotations are provided around right levels with the right amount of liquidity at all times on the exchange.
Okay. So Siddharth, going back to the fundamentals of the fund, so do you think that this is kind of a focused US tech theme fund with a high risk and a high reward proposition?
So let me quickly use the presentation to again just illustrate a couple of points. I think,
Sure, Siddharth.
yeah, I think numbers talk better than we talk. So just focused portfolio will typically have higher volatility, and
Right. Yes.
that's what we can see even this in this slide also. So if you look at returns, it's phenomenally well, almost 18% more than Nasdaq 100 if you're looking at a 5-year data. But correspondingly, you can see volatility is also on the higher side. It's 33% versus 24% of Nasdaq. But I think what you should also focus on are two things: return to risk ratio, at how much return you are generating per unit of risk, and plays a very important role, because it tells you, yes, you are taking additional risk, but are you getting compensated by that? And if you're looking at that data in this particular column, we are seeing that return to risk ratio of FANG Plus historically is 1.4 compared to 1.2 of Nasdaq 100, which means that you're getting better compensation in terms of return to risk ratio for a FANG Plus index compared to a Nasdaq 100 index.
Right.
Also, what very interesting analysis which we did was we just looked at the kind of outliers or extreme observations we are having in FANG Plus versus Nasdaq 100, and we actually found out that in terms of that, Nasdaq 100 was having more extreme observations or more extreme daily movements compared to a FANG Plus index. So while it's a concentrated portfolio, it has an absolutely higher volatility in absolute terms, but return to risk ratio is better in terms of outlier observations or extreme observations. It is lower than the Nasdaq 100. So we feel that a person who obviously wants to take exposure or a concentrated exposure in known companies which are leaders in their respective domain,
Mhm.
mega companies in terms of the market cap. FANG Plus provides a very good opportunities. both from a wealth creation point of view and handling the risk part as adequately as possible. Because remember that this is an equal weighted portfolio, and that is why risk gets more diversified compared to any other concentrated portfolio.
Okay, sure. So it's a focused passive fund with a lower concentration and lower risk, right?
It's a focused portfolio with an equal weighted exposure, which has created wealth, but with a higher volatility, but with a better return to risk profile. I think we
Sure,
can put it that way.
sure. So, would you like to say that that this fund is currently right position for the investors for their portfolios?
So I think there are a couple of things which people point out when we are talking about tech stocks, big tech stocks. One is obviously the levels which they are trading at, whether it is the right time to enter or not. And second is obviously the horizon, right? What should be my horizon? Let's talk about levels only. On the screen also you can see the 12-month forward PE of FANG plus stocks. We're looking at Alibaba at 19.7, we're looking at Facebook at 20, and we're looking at Alphabet 26. What we have done is we also put the Nifty 50 constituents PE on the right hand side, which just shows that at what levels you're talking about from an Indian equity market point of view also. And then these are the FANG plus companies which are showing very good potential from an earnings growth point of view, right? We're talking about Tesla growing 50% on an absolute basis for years to come. We are talking about companies like Amazon and Alphabet and etc. diversifying their portfolio by creating more revenue streams. So I think the valuation of these FANG Plus companies are justified from a point of view of the opportunities which they are creating. It's not only about the current opportunities, it's also about the opportunities which their products and services will create in future. And these companies have justified their valuations for such a long time. And even the earning projections which you are seeing seems very attractive. Just one last point, FANG Plus index in last 3 years have traded at historical PE levels of around 34.2. Right now, it is just zero point 0.3 standard deviation higher, around 36,
Okay.
whereas Nasdaq 100 PE is around 28, which is one standard deviation above its historical average in last 3 years of 23.6. So when we are looking at these points, FANG Plus seems to be more attractive. Even now, as we are talking, decent correction have taken place. We are looking at FANG Plus at 7.5% lower value than historical highs. We are looking at Tesla down by 25%. We are looking at Alibaba, Baidu down by almost 30%, if I'm not wrong, and other few stocks also down by almost 7 to 10% range. So it seems to be a good opportunity to take exposure in FANG Plus stocks in the current dip and have an investment horizon of, let's say, at least 3 years when you're talking about these big tech stocks, and enjoy the wealth creation journey of these companies.
Okay, sure, Siddharth. So, Siddharth, any concluding remarks for your product?
Yeah, so first of all, we feel that investors should obviously evaluate investing in global market. It provides very good opportunities to invest in companies which are part of our life also, which are capturing a lot of mega trends, which are very innovative companies, and these companies are big. These have created wealth historically, and from what we can observe, seems to seems to the fact that they will continue creating wealth in future also. Any investor who wishes to invest in this particular product or any global product obviously should understand the objective of the fund and his own risk profile and investment objective. And if both of these align, he should ideally go ahead and invest in the concerned fund. From the same point of view, if any investor wants to take exposure in these known 10 stocks which are high growth tech internet media companies, he or she can obviously go ahead and either choose the ETF or the fund of fund, depending on his or her preference as the investment vehicle to take exposure in the FANG Plus portfolio.
Sure. Thank you, Siddharth. In fact, thank you for answering all our queries. It was really an insightful session for all of us. All the best for your NFO. Thank you, iFAST team and Mirae Asset Management for facilitating this conversation. If you would like to know more on iFAST or communicate, please feel free to email us at research.in@ifastfinancial.com. Please stay at home and stay safe.